Hello, I'm Dr. Richard Peterson. I'm a psychiatrist and an author of these books here on the psychology of investing. I've got a background related to quantitative research and trying to really make a hard science out of the soft science of investment psychology. So what we do in these books is try to help you understand yourself and also to understand markets from a psychological perspective. So we'll have a key word as well for our announcement at the end.
The first question I have, Richard, is that what sort of group of people in Japan should read your book or area of the psychology of finance?
So I think most beginning investors and traders are learning about prices and company fundamentals and things like that. And after they've been trading for maybe 1 or 2 years, they realize how important the psychology is in the mind. And so I think this is for investors who have a little bit of experience, who've realized that markets are really a human construction, and that in order to understand markets, we need to understand people. And to understand people, we need to understand how they think about buying and selling and what they're looking at. So I'd say it's not for the beginning investor, but it's for the moderate to more advanced investor to understand what is the market thinking about? What are the other investors thinking about?
Interesting. So you think the reader should have some general idea of the market, what together with the experience of the market investment?
I think so. I think that helps because if when beginners read this book, I think it's easy to say, oh, okay, these are mistakes other people make. So in my first book, we talk about the mistakes that investors make that are very common. But if you haven't traded in the markets, you haven't experienced that these mistakes are common for everyone. Instead, you might read the book and think, oh, that's interesting, but that's for somebody else. But once it's happened to you, it becomes very personal. And then we learn faster and we develop faster once we've had the experience. That's why they say the market is an expensive school. The tuition is very high. Because as we're learning and making mistakes and losing money, we're also gaining the experience to understand ourselves and the types of mistakes that we make and what we're missing in markets. So this book helps people understand what they're missing and how to think about markets and how to see people in markets, how to understand themselves in markets.
So this is what you were just saying is just terms of the investor psychology. How are you going to, easy way to explain what is investor psychology?
Right. So the easiest way to explain psychology is to think about fear and greed. So back in 1755, Munehisa Honma, here in Japan, he wrote in his book, which was the second book ever written on financial markets, he wrote, when all are bearish, there is cause for prices to rise. And the idea there is if everyone expects bad things to happen, prices go the opposite direction. So there's something psychological there. And then if you go forward 300 years to Benjamin Graham in the United States, who's one of our famous investors, he said, buy from pessimists and sell to optimists. Yeah. And then Warren Buffett, who's a student of Benjamin Graham, says, we buy when others are fearful and we sell when others are greedy. So this idea of fear and greed, or optimism and pessimism, or bearishness and bullishness, that's the psychology, but it's usually we get caught up in that because humans, we follow the herd. But often, when the herd is going in one direction, they'll all run off a cliff. And so we need to know when are people going in the right direction together and we need to follow them, and when are they about to go off a cliff so we can get out of the way and maybe make money on the downside. So that's the role of psychology is in understanding what everyone else is thinking, because those people's thinking is what's driving the prices. So if we want to understand markets, we have to understand people and what they think.
Why you picked the Mr. Honda's book? It wasn't the second book that you read?
I'm sorry, which book?
The book you mentioned in Japanese book, right?
Oh yeah, Munehisa Honma? Yeah. Honma. Yeah.
Well, how did you find it? It's not very common in the United States.
Yes, but it was translated into English maybe 3 years ago. And so it's available on electronic as an ebook. Yeah.
Oh, okay.
Yeah.
I didn't know. Okay. Well, I saw that many years back, but beginning I didn't bother to look at it.
Yeah, I mean, like all of these old books, they're difficult to understand. And sometimes the writing is not very clear. But there are some interesting bits in the book, interesting parts of it.
I see. Well, I think when I met you 2 years ago, you mentioned in an interview, I think even the book, that many investment psychology books are just commenting on the market itself. It's never been talking about the psychology though.
Right.
And then, if you're talking about the psychology, a lot of books talks about brain.
Yeah.
Right. Oh, that's not easy to understand it.
True.
Right. We do know we have one. You know, so the brain, psychology, is it really for trader have to understand it?
Well, it helps. So to understand the importance of it, it helps to think about some of the research that's coming out. So last year, Richard Thaler won the Nobel Prize in Economics for his work on the irrationality of investors. Problems called, biases called the anchoring effect, house money effect. Also, he runs a mutual fund that has been outperforming the markets, or he's a partner in a mutual fund that outperforms. So there are ways to translate that knowledge into successful investing. So he's proven that and won the Nobel Prize. So that's one thing. But also, if we look at research studies, like we used to give a simple experiment when I did a postdoc. Some people in the lab where I worked get offered a choice. They'd say, I'll give you $10 or I'll give you a coin flip. And if the coin lands on heads, you win $30. If it lands on tails, you win 0. So the expected value of the coin flip is 15, and the rational person should always take the coin flip.
Right.
But what we find is when people are asked to choose between the guaranteed money and the coin flip, about half of them take the guaranteed money and half take the coin flip. But if you showed them a face of a man or a woman before that, and if the face has an emotional expression on it, and you just ask them, label it as a man or a woman, and then take this choice, 30% more people will take the coin flip if they saw a smiling face than if they saw an angry or a fearful face. So that's strange. But what's more strange is that 0 of the people in the experiment, none of them believe that the face changed how they made their decision. So they don't believe that the expression on the face or the face changed them at all. But 30% of them changed.
Change, right? Yeah.
And if that's 30% versus a fearful or an angry face, so there's a big gap. And then if we change the words, like this is a risky coin, or this is a fair coin. Risky, fewer people take the bet than if we call it a fair coin. But as you know, it's a coin with 50-50 odds.
That's right.
It shouldn't matter at all.
No.
But there's a big shift in the words that are used and in external cues like this. But none of the people believe that these affect them. But there's a big shift. And when you look at, on a big picture, you look at the world like retailers, like Walmart, their logo is a smiley face. Or Amazon, the world's largest online retailer, has a smile with a smirk as its logo, which is, it's doing something called emotional priming. It's creating an emotional state that changes whether we take risk or not. And if you think about Genki Sushi, with a big frowny face. Are you familiar with their logo? Yeah. I mean, that's kind of a funny face. But it's interesting how people use faces to create reactions to emotionally prime investors. And we are all affected by information around us, but we don't know it, and we don't believe it. That's why it takes a few years of experience before people realize that something's wrong with their investing. What is it? Maybe they're missing something. And then they realize, oh, I'm missing something probably psychological, and I need to understand it. And that's when they read these books and they find them very useful. Because then they understand why Richard Thaler wins a Nobel Prize, why his mutual fund is outperforming. Because there are these tricks in our minds that we fall into each time. Yeah.
Very interesting.
Yeah, I enjoy it.
Yeah, because just it's almost like, whatever people said about the market, just go, opposite where you make money. Some days, right? It just, I don't know,
Yeah, I mean, we also in our second book, in this one, we look at data based on the media, the news and the social media, and we see certain patterns that are true all around the world in stock markets. One of the simple patterns is that if a company has a lot of good news about its fundamentals, like good earnings, good balance sheet, growth in its sales, it will tend to, if it's in the top most positive companies in the last month, the price will actually go up for about 90 days above the market. So a good 3 months it'll keep going up, versus those that are the most negative, fundamentally, they tend to go down. And there's a nice big gap that opens up between them. And we see it everywhere in the world, from the most positive to the most negative companies, they spread. And then another funny thing we find is that when people become very negative and emotional about a company, especially when they're angry at it, they sell the shares, but the shares actually come back very strongly. And this is similar to what Warren Buffett said: we buy when others are fearful, or Munehisa Honma, when all are bearish, prices rise. But we found very specifically it's anger. When people are angry everywhere in the world at a company, like there's a scandal, the company will come back. It often reconstructs, it rebuilds itself, and people forgive it. They forget about the anger, and they forgive, and the price will come up a lot more than the market. So we actually opened a small fund buying angry companies in January, and so far it's outperformed the S&P by about 7% since it was launched just 4.5 months ago. So these strategies really do seem to work, not only in historical testing, but since we found this, and in real time. It keeps working.
Well, you mentioned about the data. What is it actually? What is the sentiment data? We hear a lot about it.
Yeah, that's right.
What is it?
So I'll do a little historical mention again. So Honma was the first person to create data about the markets, because before him we didn't have price data written down. So he created price data and then created candlestick charts so he could understand how prices move. But we didn't have any data besides price data until about 100 years, about 90 years ago with the Great Depression. Governments wanted to understand companies, and banks needed to understand the company balance sheet. So we began to get accounting data, like about earnings and debt and things like that. So that data came in the 1930s. But then everyone knew and talked about the importance of psychology, but it wasn't until about 15 years ago that we got enough conversation on the internet, on social media, and everyone started reading their news on their smartphone and on their laptop. And now that information flow, instead of calling your broker and finding out the latest rumor, people look on the internet. And so now our computers can crawl and scrape all of that data off of the internet, all of those conversations, and convert them into numbers. So if somebody says, I think Sony is going to be bought out next month, that rumor about a buyout, we can grab that, Sony buyout next month. So we can say in the future tense, somebody says there's going to be a buyout of Sony, and we add +1 to our rumor score for Sony is going to be bought out. And every day, if the thousands of people start talking about that, then our score goes up, and the price of Sony usually will follow. So what we see with this data, though, is often some information is very quick, like Donald Trump makes a tweet, and it hits the price quickly, but then it'll drift in that direction for a few days also. Some information, though, is hidden and takes time because there's millions of articles every day, and we can't read them, all of them, as traders. But these computers can, and they can convert all of that data into what we call meaning, like streams of numbers. And we can see, I see you have a chart here, you can see how people's mood rises and falls about stocks. And how the media, like the news, is good and then bad and then good again. And when you follow the cycle, you see that actually when it's good and it turns bad, markets tend to fall. But they fall after it becomes bad. And then when it turns positive again, sometimes the markets recover, but it takes them some time. And you can time a buy and a sell, or a long and a short position, by following the media. So the media leads the price. Sometimes, not always, but sometimes. If that makes sense.
Yeah, so you need to have this certain vocabulary to identify or to make numbers or data. Right?
Yeah, that's right. The dictionaries, yeah.
I see.
Yeah. So we do an analysis of the structure of the language, like grammatical analysis of the sentences.
Right.
And so we know that like IBM is going to buy Sony, or Sony is going to buy IBM. We know which one is acting on which. And then we create a number based on which company buys which company. So there's language analysis software that can do this for us, that we pull together as part of our analysis.
Oh, okay.
But we also look at references, like people say, this is a great deal for Sony, or this is a bad deal for Sony. And all the people who say good and bad, when we collect them all together, we can create a percentage of all the conversation about Sony that's positive or negative. And that percentage, as it changes day by day and week by week, actually predicts where the stock is going. Not perfectly, but to some extent.
Wow.
Yeah.
So it's all get to conversation, communication, stuff like that.
Yeah. Yeah, so it's all converting all of the conversations into numbers. But there's so many millions of them, we can't read them anymore as people. As humans, traders can't read everything, but we can collect it and then see how it affects. Then we can test it for 20 years, and that's what our book is about, is testing it and seeing what are the themes that drive prices.
I see.
Yeah.
I see. One of the fear and greed index that everybody knows, like a CNL, shows that for the stock market in the United States. Yeah. And it seems to be the stock traders knows about this, psychology or sentiment stuff for many years. I don't think they know how to use it, but they know there's a fear and greed index, just like VIX.
That's right.
Do you see some similar sentiment data available for the currencies?
We do. Yeah, we actually produce sentiment data for every tradable asset, from residential real estate and commercial real estate, 45 currencies. We even have the Czech koruna and the Peruvian sol, in addition to the euro and the yen and the US dollar, of course, the Chinese yuan. And then we see commodities, 36 commodities, over 100 cryptocurrencies as well. So we're tracking every major tradable asset that we can get, even commodities from every energy and agricultural commodity.
But it's not available for the public,
Well, it's not cheap. And it is in some websites. So like Japan Post Bank has it in their website for some subscribers, like premium subscribers can see the data. It's on the Thomson Reuters Icon terminals. They have an app, a free app, where the data is. So that's free. Then there's SBI Holdings is a customer now for the data. And Mitsui Sumitomo uses it for currency trading. They use a sentiment for currency trading. In fact, they mentioned that they had a model last October at a conference. They told me they have a model trading currencies using the data and is outperforming their human traders. So the human traders are frustrated with the model because it's beating them. So the information flow can be built into models, computer models, and then that work quite well, that beat humans themselves. And that's as the markets become more automated. As traders, we need to know where our advantage is.
Right.
And the advantage is not in reading the news and reacting to news. The advantage has to be in something more specific, because the rest of this is being taken over by the big banks and hedge funds that do this work.
I see. Well, so far for the, I can see the sentiment, index more on the stocks, not in the currencies, not in the commodities.
No,
I'm talking about the general public there.
Oh, I see.
So once we start getting those for free, let's say for the currencies.
Yeah.
So market we're going to be change reaction also?
Maybe, but I can tell you a funny story about why that might not be the case. So. Again, most investors, the beginning, they don't understand how important this is. So we put out, we had an account on StockTwits, which is an American website, sort of like Twitter, where people talk about stocks. And we would publish every day, we would publish some charts of stocks that had high fear or low sentiment. For example, we would publish 10 or more charts from a robot, and the account said it was a robot. And within 1 year, we had 20,000 people following the account, looking at the reports. And we were getting messages to the robot, people sending messages like, your fear chart is scaring me, I think I should sell. And so we realized that when we would put out a fear chart, it created more fear, and people started reacting to it when they should be thinking about buying
right,
when there's a lot of fear. So the new investors, most people, see fear and they get scared and they want to sell. That's about 90%. But then the 10%, the more experienced ones, say, oh, no, this is an opportunity, I need to watch it and then when it bounces, it'll go quick. So I need to wait and keep a trailing stop, and then when it bounces through my stop, it'll probably keep going up. You know, so there's different strategies, but the experienced investors know how to do this. The inexperienced, they need to learn, and these books should help them learn, help accelerate so they don't lose too much money while they're learning. Yeah.
Interesting. First time I read your book and went to the website, I think a couple years back, there's a chart that shows the sentiment data was actually put into the MACD, technical indicators. Right. And I look at it, and I look at the price MACD on my screen.
Oh, yeah.
It's identical.
Really?
Yeah.
Oh, interesting.
It's identical, but sentiment MACD is taking lead.
It's usually leading, yeah.
It's faster.
Sentiment is faster.
And it not only just the reading, it shows the emotion high or low.
Yeah.
You know.
Yeah.
Well, that's the huge advantage for the trader to know, right?
I think so, and you know that. But many new traders have to learn about that, because you see, like I said, in the markets, we have this price data and we have the fundamental data, and everyone who goes to school and gets a finance degree learns about fundamental data. And then a lot of people do technical analysis and learn about price data, but almost nobody learns sentiment analysis. But if you think about what really moves prices, it's sentiment. It's the information that is hitting the markets, the new information, the good news and the bad news. That's what makes the prices go up and down. Right. And if you want to predict the prices, you have to know what information is going into the markets and what people are going to think about it and how they react to it. So if you really want to predict markets, you have to know the emotions, the psychology of it. Most people now, they're using tools based on what happened in the past. Right. But if you want to predict the future, you have to know what people are thinking about now and what they're likely to do when they think that way, how they react. So that's the goal for this data.
I mean, it's kind of easy to understand or read and easy to understand it, but it's actually try to use it.
It's hard to use, because sometimes the markets move, like you said, with the MACDs of price. Sometimes they're slow, they're lagged. But same with the sentiment. Sometimes the sentiment is slow because it's a long moving average, and the information just isn't coming fast enough, or something very, very important happens on one day. But if you have a 30-day moving average, that's only 1/30th of all of it. And if you're weighting everything equally, you don't know. So there's new ways that we're looking at of creating new averages so that important information that gets talked about a lot will hit the average harder. But we haven't done that yet. But there's a lot. But again, it's a whole new science, studying how people think. In markets, we learn about financial markets in finance degree as something rational, like something about economics and accounting. But what really they are is a human construction. And we really need to understand people to understand markets, and we need to understand the information, and that science isn't there yet. Even with Nobel Prizes and research like in this book, there's still not enough people who get it. It's going to take a whole generational change, I think. But those people who do learn about it now have a big advantage in the future. Like we've had interns from universities in our company who work with us, and then they get hired by all the big banks, and very quickly they advance because nobody else at the company has any idea how to use this type of data and how to think about markets in this way.
I think we are moving towards more sentiment, current condition of market, how the market and hedge fund using this kind of, new type of data. But I think we have to go back to the general, leader of the books. You mentioned many times the environment will affect, the people's thinking, all this. How should the environment adjust to keep the investor in a good mental condition? What sort of things they have to?
Well, that's a big question. So actually, sometimes I give trainings to hedge fund managers and banks on exactly that, and the trainings are an hour long. So I'll reduce it to so there are simple tools that we can do. I mentioned that idea of emotional priming, that when you see a face that's smiling or a face that's angry, it changes how we take risk. So we need to control the emotional priming around us. We need to make sure that the information we're receiving is useful for our decision making. So we just explained that the news is not good. If you're reacting to the news, you're probably too late. All the data in the hedge funds are beating you. So you need to think about, you need to understand it And there are still advantages there, but you need to understand it. And you need to be careful not to get caught into this trap. So we need to control the information sources. We need to construct an environment that makes us feel like we're working in a light, easy way, not a serious, concerned, painful way. We need to create a light, positive environment for ourselves. And one way of doing that is every day imagine in your mind who you want to be that day. What kind of successful trader are you? And who is your role model? What do you know about them? Imagine yourself like them, trading like them. So if a bad thing happens in the market, and imagine that, if a bad thing happens to you, what would your role model do? Would they cut their loser right away? Or would they hold on and go to the refrigerator and get some milk and coffee and try to go for a walk and avoid it? No, usually they do something. They look at it and they're not afraid of it, they're courageous. So think about your role model and how they trade, and imagine yourself doing that each day. So that's one way of changing your mind. Another way is, the markets can be very stressful. So another technique is to write a gratitude list. So every day write down 3 things that you're grateful for in your life, 3 new things. One of them could be something in nature, like a beautiful, the shape of a tree, or the feeling you get, sitting by an interesting rock. Write about the gratitude you feel. Or number 2, an old relationship in your life, somebody who supported you or helped you in your life. So write a memory about that. And then the third one can be anything else you feel grateful for. And write 3 things every day you're grateful for. And just those 2 exercises, visualizing yourself succeeding and writing what you're grateful for, both of those are proven by research to increase life satisfaction and grades for university students. And probably because of grades improving, it probably actually improves lifetime earnings as well. So there's long-term benefits from those types of exercises. But that's only 2 of many.
Yeah, I know. There's more many, right? Well, same time, Dixon's law, it shows that, you probably need some type or little bit of the pressure yourself to concentrate.
Yeah.
Right. Talking about the pressure, or you just mentioned about the pressure, it was not going to be too good. But according to some of the research, we need to have that to get the concentrated,
right?
To get the performance done, or get the better return or better performance, right? So do we need this some kind of stress or pressure to do things?
Well, we need to reframe. So a lot of people think that pressure should be around making money every day or making money every month or week. But that's the wrong way to think about it. The pressure should be to improve our process. So how can we improve our decision-making process? And every day we should go in wondering how to improve. And we should document all of the mistakes we made, all of the losses, all of the misses, because it's also a mistake if we miss a trade. And then also document all of the gains, all of the wins we had. And write down everything we did right and everything that maybe we did wrong. And more importantly, not just what we did, but the way we were thinking. How did my thinking and my process lead me to this trade and help me make money? How did my thinking and my process lead me to a trade that didn't work? And then after we write that down for a few weeks, we can see patterns and say, so I've been too focused on making money, and so every time it goes up a little bit, I take my money out of the market, but I let my losers stay too long. So we see these patterns in ourselves. And so we need the stress to improve our process, but not stress to make money.
I see.
It's not about the game. If you focus on making money, you'll lose in this game. You have to focus on doing a great job. Sort of like a worker at Toyota, the famous workers at Toyota who are encouraged to report problems or report ideas for how to be faster and more efficient and better. We need to do that in our trading. How do we get better and faster and more efficient every day? So one other exercise, a third exercise, is to ask yourself every day, what can I learn today? How can I keep learning today? And what can I do better about my process today? So how can I learn to be better? So ask those questions and then think about trading from that perspective. How am I going to learn today? Because life is learning. We're always learning to get better. And if we're not learning to get better, then our tools will get old. It's a very competitive world. and we'll start using the tools that everyone else has advanced, and we'll fall behind. So we always have to be learning, and markets are a great place to experience that. They always change.
I see. So too low stress, we're not going to be learning anything? Just too relaxed?
Yeah, too low stress.
Well, but probably stress is the wrong word, I guess.
No, actually stress is the right word. But if you think about it another way, people who play video games a lot, gamers, or short-term day traders who stay up late, they need a lot of stress to stay interested. When they're in a calm environment like this, they'll look around, they're bored, they can't make eye contact because they need stimulation. That's too much stimulation for the brain. Their brain is changing. They need to take the time to relax, actually. Some people are so for them, they need a lot of stress to pay attention. But that's unhealthy. So we should get people back to a level where they can relax and think about their process and what they can learn. But if people are so stressed that they can't take the time to write down their goals in their process, not goals for making money, but goals for improving their trading, then they're too stressed. And if they're too lazy to do that, then they're not stressed enough. So that's the difference.
Interesting.
Yeah.
I see. Well, it's. I think you already mentioned so much difference between the individual styles and all these. Even now in Japan, I see a lot of corporates testing the newcomers for the NEO exam, stuff like personality exam. Is it useful to go through to find who you are first, or it can be used to some way to communicate to other people? How are you going to use it? Is it must have one of those?
It's in investing. So we have free personality tests on the internet. We've had about 30,000 people take those tests. They're in English, but if you find a Japanese version, it's similar. They can be similar quality. Those tests are useful in helping people identify their vulnerabilities and also their strengths in their personality. Because you see, it's difficult for us to understand ourselves because we can't. Unless we have a mirror, we can't see ourselves. Or if we have a spouse, our spouse will tell us, you're doing something wrong. You stop doing that. But often we don't even listen to the spouse. So to understand, we need to actually take a test and see who we are relative to other people. Like, why are we different? So there's some things, but everyone can succeed regardless of their personality. So I've had some traders who are very anxious, always anxious, staying up late at night, waiting for central bank announcements. And they're very, very successful also. But they're very unhappy. But they're successful, and in some way they enjoy what they're doing. But it's very painful. So
there's no particular pattern or character to be successful traders?
Well, the number one pattern is openness to new experiences, meaning people learn and reading and having a flexible mind. That's the number one survival characteristic of that's for longer-term investors. So that's the key one. The other pattern that we see is not in personality, but in cognitive tests about how people think. People who have a high risk IQ, meaning when a lot of numbers are coming at them, they can very quickly figure out the best trade. And we have a test on our website that measures this. Those people do well also. But we can actually learn, we can improve our risk IQ. The way we do that is by reviewing our trades and other people's trades and figuring out, what do the best traders do? What do I do when I'm doing well, and what do I do when I'm not doing well? And we review those and we think about them. And we try to understand the big picture rules around that. People who review and learn, they do better. But then there's an exception. Sometimes people spend too much time learning, and they're too much of a professor, and then they're not actually living.
That's right.
That's a problem too. So you have to, make it a small part of your time to review, but not make it too much of your time.
You still have to be the action you have to take.
Take action, to learn from it.
That's right.
Yeah, and sometimes if you think too much about your actions, always trying. So I don't like trading journals. I like it if you review afterwards at the end of the day. Think about what happened that day, and think about it without judgment. Think about it with curiosity and even playfulness. Like, oh, I'm curious. What happened today? Let's think about this.
Oh, that's totally different from normal trading journal, right? Trading journal, we're talking about, how we did it, how much we made, how we miss it.
Right.
Everything had to do with the trading plan, so to speak.
Yeah, so the trading journal, I think, sometimes is too much of a burden on people. I think it's more important to just look at what happened, what did I miss, what did I win, but the key thing is the attitude. Don't do it like a punishment. Do it because you're happy to learn. So George Soros, one of the world's greatest traders, maybe in history, said, I'm not ashamed, something like this. He said, I'm not ashamed about finding mistakes. He said, I'm only ashamed if I don't find my mistakes. Because he said, there's no shame in being human, because all humans make mistakes. The shame is in failing to correct our mistakes. So we need to look at our mistakes like with joy, as an opportunity to learn. Like, oh good, I lost money, now I can figure this out. Because if we look at them like, oh man, I lost money again, I'm a loser, I need to work harder, that's wrong. Not in markets, that's wrong. We don't learn that way. People learn not from pain, they learn from curiosity and excitement. And the financial markets require that because there's so much pain that's already there. You don't have to give yourself more pain.
So sometimes you have to be away from that to start running, right? I mean, if you're in the same situation, actually you're not going to learn anything.
Right. If you're too stressed, stress impairs learning. So when people have high stress, they can't learn. And then you'll see people who have a lot of stress in financial markets, they make the same mistake again and again, and they create like a downward circle. And it'll be amazing. I've had that experience. I once lost, I lost money like 17 times in a row, which statistically, how is that even possible to lose 17 times in a row? It's crazy. But another time I had a mechanical system that won 23 times in a row. So you have these weird long strings, and it can be very painful. Like, you have to know that you could lose 17 times in a row and be able to maintain it. So how much capital are you really willing to lose? 2% on each trade? Be careful. So we have to think about that, and if we're too stressed about it, we won't be able to learn and then come back. Instead, we'll get in a slump and we'll never come back. And slumps and losing periods happen to everyone in the financial markets. It's inevitable. But most people who get into trading are very optimistic and they think they'll always make money. That's not true. We will lose sometimes. So we need to have the ability to feel good about our learning, about our process, and to know this is a long road. Becoming a successful trader is very difficult, and there's a lot of competition. So we have to enjoy it.
Oh, I see.
We can't beat ourselves up or be stressed about it.
I see. Well, it's very interesting to learn from what you were saying about learning. Actually, is faster shortcut to make money, right, so to speak, because you're learning to prove.
And it doesn't seem like it. So most people don't think that learning is how they make money. But even now, it's sort of a fashion in Silicon Valley. You look at a lot of the CEOs will take a day of their week just to read books. Say Warren Buffett reads one 500-page book every day, equivalent 500 pages every day. So it's people they're using this now as inspiration. They're like, to be very successful in decision making. And in trading, it's a decision-making game. It's a game in your brain. We have to learn. We have to feed our brain, and we have to take time to think. Sort of like a race car. We can't run the car without stopping to put in oil and change the tires and change the brakes and put in gasoline. We need to do all of that. But a lot of traders just want to run that car until it runs out of gas and falls apart. But we can't do that. We have to keep learning to maintain it.
Keep learning to maintain. I think that's the whole thing.
Yeah, that's right. You can cut everything else.
Well, I think we covered just about everything mentioned, and it's really it's always amazing talking to you about how important to understand the nature as well as the learning psychology as well as how the brain works and everything. It's very difficult to connect it to the making money. We understand how the brain works, but we don't know how to use that to make money. Just cannot connect it. Right.
Interesting. Yeah. Well, the key really with making money is to have an advantage, an edge.
That's right. That's not.
But you have to know. But we have to know what that edge is.
Right.
And we can't. So a lot of people will sell you an edge, like a book that says, or even like our sentiment data. I say, here's the sentiment data, but as you can see, it doesn't always work. On average, it works. On average, it makes money, but it doesn't always work. And most people want something that always works, and that's a lie. Nothing always works, right?
That's right.
So we have to become comfortable with uncertainty and comfortable with losing money sometimes, and know that longer term, if we have a real edge, we're okay. But there are other challenges, like in value investing. Some investors only buy these cheap companies, and around the world, that has been a terrible investment strategy for the last 9 years, 8 years, and they've done very poorly. And during that period, technology companies that were spending all of their cash on growing, they did the best because they were reinvesting all of that money quickly and growing. But value companies were not. They were spinning off dividends and having high earnings, but not really spending it on research and development. So we have to understand when the world is changing.
Right.
When there's a low interest rate environment, we need to take all of that money and reinvest it cheaply and keep growing. So but that's easy to say in hindsight. But if you asked a value investor, they'd say, well, for the last 100 years, value investing has been successful. But you can't. Your investors won't listen to you after 4 years of loss. Well, we created our sentiment data to trade it ourselves. But then we found that trading ourselves, there was a lot of ups and downs. So we ran a hedge fund from September 2nd, 2008 until the end of 2010. And it's in our second book. And so we beat, for the first 12 months, we were in the top 1% of hedge funds. But then it stopped working and it just sort of drifted down. So in 2008, we made 5%, 2009, we made 30%, and in 2010, we lost 8%. And so we couldn't raise money that way, but we realized we wanted to work on this data. This data is the most important thing. And then as we started to sell it with Thomson Reuters, Refinitiv, it became very self-sustaining because now we have customers in 22 countries, and we get feedback from our clients that teach us how to use the data even better. And we realized there's a whole area of finance that's missing, which is the mind. And we can create products that will help improve that. And as a business, it's a lot more satisfying than the stress of trading, the daily, day-to-day stress. But we also do enjoy longer-term investing. And we've seen strategies again and again. So we did launch also, while we have this steady revenue stream from the data sales, we then found, okay, now we can take risk again in the markets. And so we ran a machine learning-based fund that was a daily strategy in 2016. And that was up, I think, 14% net. It traded for about 10 months in 2016. But we shut it down at the end of 2016 because with the Trump election, the sentiment changed. And it stopped working. It started going up and down quite dramatically. And that wasn't expected. So we shut it down. And then we fixed all of that. And then in January, we launched our anger fund. But this time we're really excited about it because we're giving all of the profits to mental health charities. So
different purpose then.
Yeah, so the whole purpose of that one, we're making money, but we're not keeping it. We're just giving it all away. But we're buying these companies that are really scandalous, often bad companies. But and I talked to some sovereign wealth fund managers about it, and they said they could never buy these companies because these companies have done such bad things, like they lie or they have product
get
problems.
Approved, right?
Yeah, their investors, they don't buy that company. It's a bad company. But they do the best in the price. And so we thought, well, we'll take that money and we'll give it back to mental health charities and domestic violence shelters and things like that.
Well, they can buy your funds rather than they invest on it themselves.
Well, I think their investors wouldn't want to because it's sort of an anti-ESG. Like we're buying the bad companies.
Right. But it's always going back to the psychology of the market.
It is. The bad ones do the best.
That's right.
Because they do the best because they improve themselves.
Right.
When people get angry at them, they change how they work. So there's a company in the United States who had a CEO who was a racist, and he made really bad racist comments. And he said, "That's okay, I can say what I want." But his customers said, "We're not buying your pizza." It was a pizza company. They said, "We're not going to buy any more pizza." So the sales dropped, and then the board of the company pushed him out. And a new activist investor came in, and they got him out. He still owns 30%, but he can't control anything. And then what they did was they hired new people, and they created the first vegan pizza in the United Kingdom, which won awards. And so all these animal rights activists love them and now come to their pizza stores. And it's really interesting. Their sales are growing, and so as a business, they've turned it around, and they're doing quite well.
Nice.
or there's companies we buy, like the New York Times company, which President Trump and a lot of conservatives hate that company, and they say a lot of bad things about it. But actually, their readership is increasing.
That's right.
And so they're making more money.
Right.
And so the company's stock is going up a lot. So when people are angry at a company, it gets more attention, and it either improves itself or it just makes more money and it goes up again. So it's a funny thing.
Yeah, that could be a good tip and advice to the people who read, watch this video, I guess.
Yeah, and it works in Japan too.
That's
and it works all over the world. Yeah, so it's a global thing.
Yeah, well, I think Richard, I just cover everything,
Great. Yeah.
And personally, I got really interested on this sentiment data. When I created my own trading system or rules, everything, it's based on nothing but statistic basis, historical data,
Pricing data,
right?
and indicators. Yeah.
It get to the point. Actually, it's not going to be a good forecasting model. It doesn't really necessarily repeat itself, right? Right. But somehow, I've been looking at the greed and fear index, just a simple, basic type of the stuff for the stock, using the timing.
Okay, interesting.
As the filter, or everything works much better than anything else.
Oh, that's great.
Yeah.
Interesting. Yeah.
So I know it's missing that the psychology or mind things.
Right.
But just can't get the data available to the private traders.
It's quite expensive.
That's
yeah.
right.
Yeah.
Some of the guys have been paying like nearly $1 million per year for that type of data. Their research on it. We're not going to be able to get
ours is not that expensive, but it's a few $1,000s a month. Yeah.
But I've always been looking for some type the way that individual or private trader can access to it. Of course, Thomson Reuters, it can be,
Well, we do have so private traders in our website, it's $300 a month, and they can access all of the charting tools for 20 years of charts of daily data. We can't give them the intraday data, and we don't give them the raw data, so they can't develop their own testing, but they can look at the data and just see as a useful indicator. So you can actually look at the website and see if that's useful.
I see.
Yeah.
It's very difficult to find one of those. It's not there.
Yeah, we do have another product coming out soon for individual stocks. So we have different indexes. Right now we cover everything, all 15,000 companies, all the stock indexes. But we're creating one just for stocks, like even Japanese stocks, where it ranks all of them and then gives them a score from 1 to 100 every day. It tells you where it's likely to go in the next month, based on the sentiment only, and the media. So it'll give you the 1 month prediction. So that's a possibility for you.
What's the difference between the media and the social data? There's two you guys,
Yeah, we do
possible,
social media and we do news media.
Which one go faster or anything? What's the difference there?
Well, social media is usually a bit better at predicting.
Is that right?
Yes. So the sentiment in social media and we even have an index where we look at what people say the price is going to do. It's called price forecast. So if people predict the price of the stock will go up, it usually goes up actually. And if they say it's going down, it goes down in social media. In the news media, it's exactly wrong. If the news media says the price is going up, it usually goes down. If it says it's going down, it usually goes up. So social media actually is quite good. And I think it's because the traders in social media, they've survived. If you're a bad trader and you're making bad predictions, nobody's going to want to follow you and you're going to go away. But if you're good, you survive. But in the news media, you can be a reporter and not be good at predicting markets. And usually they're wrong because they get excited like new people in the market. It's not like old experienced people that we see in social media.
Social media.
So social media tends to be more accurate, especially over the like week to month level. News media is also pretty good, especially news about fundamentals.
Fundamentals, right?
But other types of news, like predictions or optimism or happiness in news, are usually wrong. Yeah.
That's a good point too. Yeah. I didn't
But
know
it's
that.
complicated. See, that's the problem. That's why we wrote the whole book on this data. It's a big book. So it's a new science of understanding markets. But to really understand them, you have to commit. You have to commit yourself. It's not just another book that you pick up and read. If you want to add it to your trading, it's really becomes a discipline, sort of like technical analysis. It takes time to learn about technical analysis, but there's a lot of books available. With this, there's not many books. There's one from Germany on social media, and then there's our book, and then there's an academic book.
Yeah, so most of the academic books.
Mostly academic, yeah. And you can look at SSRN, the website, which has research, but the academic research, I don't always trust it because they tend to data mine. They don't do a good job. It's not good for trading models. Sometimes they try to get good results for publication, but not for actual trading. It doesn't actually work.
Okay.
So that's a bit of a challenge with academic research.
Yeah. There's so many of that in academic research, based on it, but nobody using it, so to speak, so how can trust it, right?
Yeah, it's true. Well, a lot of people are using sentiment data in the actual live trading. So I mentioned SBI Holdings and Japan Post and Mitsui Sumitomo. So they use it for different types of trading, stocks and currencies. But then there's also ING Bank in Amsterdam, their asset management group, NN, they use it. They talk about it in the media a lot. There's research firms in New York, like Empirical Research, Union Invest in Germany. So there's others. There's quite a few. I mean, there's many others, but there's quite a few that I usually don't say any of their names, but those are the ones who've been public in the media about it. So there's quite a few that are even public about it. So many are using it. Yeah.
Oh, sure. Yeah. I think really I want to.
Cryptocurrency websites actually are using it also. Yeah, for making predictions.
I'd like to really tell the individual investor, trader in Japan to know this is the area that they should pay more attention to it, After I've been in the market for more than 30 years or so, I go through a lot of, academic stuff, working for the bank, fundamental, technical, you name it. Everything goes, right, But getting to the point, how to make money it's not necessary to do quantitative, and it's a lot to do with mind, psychology stuff. Even though the model is fully programmed or coded, it have to do with the psychology, of the market itself. You have to be into it.
You do, but it is a tricky balance. Sometimes markets are easy. Sometimes, like cryptocurrencies. Certain ones you just buy it and don't hold. Like I overthink it as well. I owned Litecoin in 2011, and I sold it in 2013 because I'd made a few tens of thousands of dollars. And then when but now it would be millions of dollars.
That's right.
So there's some things that are simple. Just keep it simple. Buy it and hold it forever. Other things that are complicated, and as an investor, sometimes it helps to just look, where's easy money going to be made? And trying to find that place is sometimes the key thing. Because there is easy money to be made somewhere. Like when I present this in China, especially a few years ago, if I talked about psychology in China, they said, we don't need psychology. There's money all over the place. We just need to take risk. If we take risk, we'll make money in business in China. But we don't need to think about other people's thinking. But then with the bubbles, ups and downs, and now it's changing in China, they're more interested in this. But early on, it wasn't that hard to make money in China. I was told. I don't know. That's what I was told. But in developed markets like Japan and the United States, it's very competitive.
Right.
It's not so easy, and so we have to figure out where is it easy. There's probably still some small easy areas we have to think about.
It could be the sentiment data if nobody using it, right?
Yeah, I mean, there's definitely, it adds value, but again, it requires some quantitative expertise, or it requires time to learn about it. You don't have to be quantitative, but you have to take time and learn and look at charts and understand it.
That's right.
Yeah. But then it is very useful once that's done. Yeah.
Okay.
So we'll have a key word as well for our announcement at the end. The key word is sentiment. Thank you.